Hi, this is Jim Welsh from MacroTides.com. When President Trump first announced tariffs on the first $200 billion of Chinese imports, many economists downplayed it by noting that, $200 billion, 10% is $20 billion, the U.S. economy is $20 trillion. It really isn't that big of a deal. And my take back then was, mathematically that may be true, but one cannot always account for how decision makers are going to respond to changes. And the reality is, global GDP has slowed more significantly than one would have assumed based on the dollar amount in trades. So let's take a look and see how over the last year, global growth has slowed. And the European Union, a little bit over a year ago, global growth or GDP growth was bouncing along at about 2.7%. It's been more than cut in half since then. China, we know that it has been slowing really for much of the last several years, but we can see how during the course of beginning of 2018 onward, growth has really slowed again. And even the United States, which has kind of been stronger than everyone else, holding up better. Obviously, the tax cut in 2018 certainly helped make that possible. But even in the U.S., we can see that growth is slowing. And a big part of that is the slowdown that has taken place in world trade, which represents 25% of global GDP. As you can see, over the last decade, and probably since the financial crisis, we've had 3 consecutive quarters where trade volume contracted. So despite the small amount of tariffs being levied over the last year, it has had a big psychological impact, upsetting supply chains and also decision making. And the biggest thing is, since no one knows how this is going to turn out, various businesses have put off making business investment, not just in the United States, but globally. But you can see, in terms of the United States, business investment spurted very nicely in 2017 and into the first half of 2018, but it has been slowing. As you can see, exports have been slowing since about mid-2018. So the two have been working hand in hand, and it reinforces my view that a lot of companies are just postponing and putting off business investment, and they will continue to do so given the uncertainty. Also, many CFOs, chief financial officers of major U.S. companies, are really pretty negative in terms of their outlook. They're looking for things to worsen. And potentially a recession, the blue bar shows by the second quarter of 2020. The orange bar is for the end of 2020. So you can see globally, most CFOs are not really very optimistic. And the net result of that means they're not about to increase business investment anytime soon. Now, with President Trump adding new tariffs that are going to disproportionately hit consumer goods and hurt consumer spending as prices are raised, or profits as companies absorb some of the increases, and some of the sectors that are going to get hit, companies other than tech companies, their profit margins aren't that big to begin with. So we're going to see a twofold hit, both in terms of hitting consumer spending and absorbing a greater percentage of it. Also, some consumers deciding not to pay an extra few bucks for whatever product it is. Bottom line is, it's going to hurt the one sector of the U.S. economy and the global economy that has been the strongest, consumer spending. In the second quarter, consumer spending was up over 4%, really powered it. So just as, if anything, in early 2018, the global economy had a nice head of steam going. The initial tariffs kind of reversed that and started the ball rolling downhill. The new tariffs have the potential of really accelerating the slowing, not just in the global economy, but also in the U.S. And I think as economists and analysts come to grips with that over the next few months, we're going to see earnings cut back, GDP estimates reduced, and the net result is I think it's going to be a challenging environment for equity prices. Thanks for tuning in. May something good happen for you today.